Two drivers live on the same street. Same car, same year, same model, same commute. Neither has ever caused an accident. Neither has a single ticket. One pays $900 a year to insure that car. The other pays $1,600. The difference is not how they drive, because they drive identically. The difference is a 3-digit number, neither of them mentioned, that the insurer pulled without asking, and that has nothing to do with the road. One has good credit, the other does not. That, more than anything either does behind the wheel, set the price. It is called credit-based insurance scoring. Insurers take elements of your credit history, things like payment patterns, outstanding balances, and length of credit history, and feed them into a model that produces an insurance score. That score is separate from the credit score a lender sees, but it is built from the same financial data. The insurer uses it to predict how likely you are to file a claim. And in their statistical models, this score is one of the single most powerful predictors of price they have. Consumer Reports ran one of the largest studies on this. They analyzed over 2 billion insurance price quotes. They found that in most states, a driver with poor credit and a clean record paid far more than a driver with excellent credit and a drunk driving conviction. Read that again. A spotless driver with bad credit was charged more than a drunk driver with good credit. The number on your credit file outweighed an actual conviction for the most dangerous thing a person can do in a car. Insurers defend it with one fact. The correlation is real. People with lower insurance scores do, on average, file more claims. The model is not invented. It predicts something. But correlation is not the same as cause, and prediction is not the same as fairness. The driver with poor credit did not become a worse driver. The model simply found that financial stress tends to travel with claims, and turn that statistical shadow into a higher bill, charged to the people least able to absorb it. Follow where that lands. Credit is not evenly distributed. It tracks income, and it tracks history that includes generations of unequal access to lending. The Federal Trade Commission studied insurance scores and found they correlate with race and ethnicity, with minority groups concentrated in the lower scoring bands. So a rating factor sold as neutral produces prices that fall hardest along the same lines as old discrimination. The model never asks your race. It does not have to. Credit carries the pattern for it. The trap is how circular it becomes. A driver with thin finances pays more for mandatory insurance because of their credit. The higher premium strains the finances further. A late payment somewhere dings the credit again. The insurance score drops. The next renewal costs more. The thing the model claims to merely measure, financial stress, is partly manufactured by the model's own pricing. It charges you for being squeezed, and the charge squeezes you harder. A few states have said no to it. California, Hawaii, and Massachusetts broadly prohibit insurers from using credit to set auto premiums. In those states, your rate is built on your driving, your vehicle, your history on the road, the things you can actually control. Everywhere else, the credit factor is legal and standard. Some states limit it at the edges. But in most of the country, the single biggest lever on your premium is a financial score. You cannot see the insurer pull and were never asked to approve. The driver paying $1,600 instead of $9 did nothing wrong on the road. But the extra $700 a year is real money, leaving a household that already had less of it. Over a decade, that is $7,000, charged not for risk, created behind the wheel, but for the financial position the driver was already in. The insurance did not respond to their behavior. It responded to their bank account, and it charged the emptier account more. There is a cruel timing problem too. Insurance scores can drop fastest exactly when life goes wrong. A job loss, a medical event that runs up debt, a divorce. The moments when a person most needs their fixed costs to hold steady are the moments the score falls and the premium climbs. The system raises the price of a necessity at the precise time the customer can least afford it. That is a known feature of scoring on financial stress, not a bug. What you can do, even where it is legal. First, know that your insurance score exists and that you can request it. Improving your underlying credit, paying on time, lowering balances does move it over months. Second, shop hard because insurers weigh credit very differently. The same score can produce sharply different quotes. Third, ask your insurer about extraordinary circumstances provisions. Many states require insurers to reconsider your rate if a major life event, like a death or serious illness, damaged your credit. That rule exists. It is just rarely volunteered. and push at the policy level because this one is genuinely contested. Consumer advocates have fought for years to ban credit in insurance pricing, and the map of states that prohibit it has grown slowly because of that pressure. When a state insurance commissioner holds a hearing on rating factors, public comment is open. The insurers always show up. The public rarely does. The states that banned credit did not do it alone. Someone had to make enough noise that the neutral math had to explain itself. The two drivers never compared their bills. If they had, neither could have explained the gap because nothing they did on the road explains it. Same car, same street, same clean record. One simply had more money, and the insurance charged the one with less for the crime of having less. They call it a score, and a score sounds objective, like a measurement of something you earned. But this one measured a position, not a behavior, and then it billed you for the position. The fine print did not read your driving, it read your bank account and it priced you to match before the next one. This channel runs on MXEL. Creators earn crypto for the content they already make without selling anything to the people watching. If you build things and want the work itself to pay you, it is at MXL.com.